Hey, Richest you money maniacs, welcome back. In this video, I'm going to talk about something new and exciting called SPACS. Get ready, strap in, because it's time to learn a completely new investment tool and strategy. Let's get right to it. Hey, Richest you money maniacs, Tom coming at you. Thanks for tuning in again. In this video, I want to talk about something I just recently learned about. It's called a SPAC. Now, a SPAC, as I understand it, and I'm just learning this, so this is really exciting. A SPAC is basically a company that is private, so they're not held on the stock market publicly, is merged to a company who is already being traded publicly, which means that now they, in essence, can be traded publicly also because they are merged with a public company. Now, the reason that's exciting is because it means that that private company didn't have to go through all of the hoops and all of the fees and all of the challenges and the time restraints that apply to a normal initial public offering. Because the other parent company is already public and they merge with a private company, that private company now becomes public and publicly traded. That's pretty exciting when you think about it, because that means their products and their revenue and their dividends potentially could help the stock of the company that just merged with them and the dividends and all the stockholders there. But here's the really interesting thing. This is becoming it is a really big trend. We found an article on goldsilver.com that I'd like to read a little bit from for you. This article comes from technocodex.com. It says, bubble warning. Even college kids are touting SPACs. I love this beginning too. When the shoe shine boy starts sharing stock tips, it is time to get out of equities. Or so Joseph Kennedy Sr. is said to have remarked as he exited the market ahead of the 1929 crash. So what should investors do when college students start promoting special purpose acquisition companies, or SPACs? This week it emerged that the University of Pennsylvania students have created a so-called Penn SPAC Club to celebrate these new equity vehicles. Known as blank check companies, SPACs raise money from investors via a public listing, and then merge with a private company, in effect taking it public while avoiding a traditional initial public offering. For the students, this is probably a smart move, at least if they want to find internship with finance companies that are profiting from this trend. For everyone else, though, it is a worrying sign of froth. The current statistics around SPACs are startling. So far this year, 133 SPACs have been floated in the U.S., raising $51.1 billion, nearly 4 times last year's volume. A further 67 are waiting in the wings, according to SPAC research. The list of SPAC managers is swelling so fast that it now includes Billy Beane, the U.S. baseball executive depicted by Brad Pitt in the film Moneyball, and Paul Ryan, former Speaker of the U.S. House of Representatives. And of course, London is trying to get in on the deal too. Part of the reason, as I understand it, that they're excited about this new SPAC idea, a public company merging with a private company and raising investor money, is because the Federal Reserve interest rates are so low that money managers who are sitting on tons of cash and are required by their contract, or required even sometimes by law, to invest that money for their investors in something that actually makes money, they don't know where to go. The normal stuff isn't working. Plus, this is very much similar to what happened in 2008 in terms of speculation. What they talk about in the article later is the idea of a SPAC on a SPAC, or a SPAC on multiple SPACs. So basically a bundle of SPACs. It sounds a lot like the subprime market before it blew up in 2008. And that's exactly what they're mentioning this for, is to keep an eye out, because it looks like this is the next bubble. And it's not a bubble that could grow and make you lots of money. It's a bubble that is already beginning to steal money away from retail investors every single day. In fact, later in the article, it talks about the fact that a lot of the SPACs that were launched are still below the required $10 limit. Let me read that part of the article to you so that you can be sure I'm getting it right for you. Inevitably, this mania is also producing investor losses. Nikola, the electric truck maker that merged with a SPAC, is now being investigated by U.S. officials in a case is a case in point. A Financial Times analysis in August showed that the majority of SPACs organized between 2015 and 2019 are trading below the $10 standard SPAC listing price. So it's not a required price, but since 2015 people have been doing SPACs and getting all excited about them, and now almost all of them are below $10. I mean, think about it for a second. One of the challenges the market has right now is the indexed funds, right? You're investing in the Standard & Poor's, the S&P 500, not in actual companies and whether they have good products or not, just that you're betting the S&P will go up, or even in the New York Stock Exchange or whatever other indexed fund, right? You're not actually investigating. So the whole idea of a SPAC on SPACs is the same kind of bundling as an indexed fund like that. And the danger is that people or investors get lazy and stop paying attention to whether the company is good or not, or what's actually happening in the marketplace. I want to read from the article down near the end because this is a really, really important point. That does not mean SPACs are going to crash tomorrow, but if they do, eventually some investors will get hurt, which is not unusual. Although there thankfully may be fewer systemic implications than with CDOs. Members of this Penn SPAC Club should read their history books as well as financial engineering manuals. And remember this, the smart money is good at passing risks on to mainstream investors when they want to leave. SPACs are not so new. So there you have it. The smart money. Watch what the smart money does. Now, you can look into this, and I would strongly encourage you to learn more about it. I would not advise investing in it. I would advise you strongly to look into a laser fund or indexed universal life insurance and gold and silver. And once the real estate market finishes crashing and all the ripples are felt and the prices finally drop to where they're dropping, they're on their way down already, commercial and private real estate, then invest in some real estate. But wait, you just wait. The way the printing is happening with the Federal Reserve, the way the government is spending, the way the economy is flailing and falling apart with bankruptcy after bankruptcy, you can be sure that if you position yourself correctly with a laser fund and with gold and silver, you will be set to be able to swoop in and snatch up all of the good deals that come out of these types of bubbles. This SPAC bubble, the real estate bubble, the indexed fund bubble, just know it has happened before in history, as recent as 2008. Go watch The Big Short again, and then think about these SPACs when you're reading up on them and what they are and what happened in 2008. So I hope you liked this video. I hope you found it valuable in learning how to master your finances and set yourself and your family up to be safe, especially as things are getting so crazy in finance and money. Because remember, when things get crazy in finance and money, the rest of the world follows suit, because that's what motivates people. Money and finance is what makes people get out of bed and go to work and do jobs that they don't really want to do, just to make sure they can eat and have a place to live. So think about that when you're studying SPACs. Think about that when you're learning more about how money works, when you're watching more of the Richest You videos. So thanks for tuning in. If you like this, please give it a thumbs up. If you haven't already, make sure you subscribe to the channel. We would love to have you. And even better, if you have a strong opinion about SPACs or even some firsthand experience, I would love to hear about it in the comments. Thanks everybody, and we'll see you next time.